Hi everyone, today we'll be going over accounts May-June 2020, paper 3 and question number 4. This is structured paper 3 which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And question number 4 is part of section A, which relates to financial accounting. Now without any further delay, let's get started. The draft financial statement of MPLC are being prepared, and the equity and current liabilities at 31st December 2019 amounted to 480,000 and 45,000 respectively. And we are given additional information regarding the gearing ratio and the current ratio. Let's have a look at our first question. We need to prepare the summarized draft statement of financial position at 31st December 2019. So in order to prepare our summarized draft statement of financial position, we first need to solve these two ratios. Okay, let's start with our gearing ratio. So we know that gearing ratio is just going to be the non-current liabilities divided by our capital employed, which is just equity plus the non-current liabilities. And since we are given it in a percentage, we need to multiply it with 100%. Alright, now we can just substitute the values. We know that our gearing ratio has a value of 20%. Then we do not know the value of non-current liabilities, so that's the variable that we need to figure out the value for. But we are given the value of equity right here. The equity at 31st December 2019 amounted to 480,000. So let's substitute this value plus the non-current liabilities times 100%. Okay. So if you were to bring this 100% to this side, that would be 20 by 100, right? And the percentage sign can cancel each other out. So 20 by 100, we can just write it as 0.20. And we can cross multiply as well. So we can bring this denominator term to this other side, right? So let's just multiply that as well. So that's 480,000 plus the non-current liabilities. And the only remaining term on the right-hand side would now be the non-current liabilities. Okay, so let's multiply these values with 0.20. So that's 480,000 times 0.20, which results in the value of 96,000 plus 0.20 non-current liabilities. And this will be equal to the non-current liabilities. Okay, so that's just going to be 96,000 equals to, we can just bring this term to the right hand side, right? So that's going to be 1 non-current liabilities minus 0.20 non-current liabilities, which results in the value of 0.80 non-current liabilities. Now we can easily figure out the final value for our non-current liabilities. That's going to be 96,000 divided by 0.80. So now this gives the value for non-current liabilities to be 96,000 divided by 0.80, which results in the value of 120,000. So the next ratio that we have is of current ratio. And we know that current ratio is just current assets divided by current liabilities. And this is given to have the value of 2.2 by 1. Okay, so we are already given the value of current liabilities. So the value that we need to figure out now would be that of current assets. And if you just cross multiply this, so that will be 1 times current assets, which will be current assets itself. And if you cross multiply these, that will be 2.2 times current liabilities. So now we can just substitute the value of current liabilities here and figure out the value for current assets. So that would be 2.2 times the value of current liabilities is given to be 45,000. So now this gives the value of the current assets to be 2.2 times 45,000, which results in the value of 99,000. Now we can move towards preparing our summarized draft statement of financial position at 31st December 2019. Okay, so let's write down the heading. This is the summarized draft statement of financial position at 31st December 2019. Okay. So since this is a summarized draft statement of financial position, we will only be recording the main headings. So let's start with our assets section. We will have non-current assets and the current assets. And this will give the value for our total assets. Okay, similarly, now we can move towards the equity and liabilities section. So the first heading would be that of equity itself. Then we have the non-current liabilities. And our current liabilities. And the sum of these three values will give us the total equity and liabilities. Okay, let's have a look above. We have our equities value to be 480,000 and the current liabilities value to be 45,000. So let's substitute this into our draft statement of financial position. So we had equity of 480,000 and current liabilities of 45,000. All right, let's have a look above again. We then figured out our non-current liabilities to have the value of 120,000. So let's substitute this as well. Okay, so that's 120,000 for our non-current liabilities. Now we can easily figure out the value for the total equity and liabilities by just adding these three values. So that's going to be 480,000 plus 120,000 plus 45,000, which results in the value of 645,000. And we know that in a statement of financial position, the total assets is always equal to the total equity and liabilities. So we can say that total assets will also have the value of 645,000. Okay, let's have a look above. We also figured out our current assets to have the value of 99,000. So let's substitute this value into our statement of financial position. So we have current assets of 99,000. And then this non-current assets value, we have not figured it out yet. So this will act as our balancing figure. And whenever we're trying to figure out the balancing figure, we just have to substitute other amounts from the total. So in this case, that's going to be 645,000 minus 99,000, which results in the value of 546,000. And this concludes our summarized draft statement of financial position, as well as the first part of this question. Now we can move towards the second one. We are given additional information. Further analysis of the equity at 31st December 2019 is given below. So we have ordinary share capital with a nominal rate of 1, and it had the value of 300,000. We have share premium of 40,000, general reserve of 28,000, and retained earnings of 112,000. And remember that all these values are at the date of 31st December 2019. Then we're also given that the current market price of one ordinary share is 2.40, the price earnings ratio and dividend yield, and the transfer from retained earnings to the general reserve during the year. So let's have a look at our second question. We need to prepare an extract from the statement of changes in equity for the year ended 31st December 2019, showing the movement of retained earnings. So this just means that we only need to show the retained earnings column from the statement of changes in equity for the year ended 31st December 2019. And in order to do so, let's solve all of the information given above. Okay, so the first ratio is price earnings ratio, and it has the value of 10. So price earnings ratio has a value of 10, and we know that the formula for price earnings ratio is just going to be the market price of the share divided by the earnings per share, and this is 10. We are already given the current market price of one ordinary share, which is 2.40. So let's substitute this. That's 2.40 divided by earnings per share, which is 10. So now we can easily figure out the value for the earnings per share. That's just going to be EPS equals to 2.40 divided by 10, which results in the value for earnings per share to be 0.24. Okay, so now we need to solve this ratio as well. So what we know is that earnings per share is just the profit for the year minus any preference dividends. But we can see that there are no preference shares, which means that there will be no preference dividends. So we can completely ignore that factor, divided by the total number of shares, right? So we have the earnings per share value to be 0.24. We do not know the profit for the year, but we are given information regarding the value of total ordinary shares as well as its nominal rate, right? And whenever we're trying to figure out the total number of shares, that is just going to be the total value of ordinary shares, which is 300,000 in this case. And we just divide it with our nominal rate. And we can see that the nominal rate is 1, which gives the total number of ordinary shares to be 300,000. So let's substitute this as well. Now we can easily figure out the profit for the year. So profit for the year is just going to be 0.24 times 300,000. Which results in our profit for the year to be 72,000. Alright, then we have another ratio which is of dividend yield, and we are given that dividend yield is 5%. And we know that dividend yield of 5% means that 5% of the current market price of ordinary share is given to the shareholders as a dividend. So let's figure out the 5% of our current market price. So that's 2.40 times 5%, which you can write down as 0.05. So this gives our dividend per share to be 2.40 times 0.05, which results in the value of 0.12. And this is the dividend per share. Let's figure out the total dividend. In order to figure out the total dividend, we can just multiply the per share rate with the total number of ordinary shares, which we figured out above to be 300,000. Let's multiply these together. And this will give our total dividend paid in this particular year to be 0.12 times 300,000, which results in the value of 36,000. So since we figured out our profit for the year, dividend paid for the year, and we're already given the transfer amount of 10,000, now we can easily move towards preparing the extract from the statement of changes in equity for only the retained earnings section. Let's do that. Okay, so we will start with our opening balance. So that would be retained earnings at 1st January 2019. Then we will add our profit for the year. Then we'll subtract the dividend paid because this is definitely a cash out, and dividends are a part paid from profit, and we definitely record our profit in the retained earnings section. So we need to subtract our dividend paid. Then we also need to subtract the transfer to general reserve. And this is subtracted because we are just putting a part of our profit to the general reserve from the retained earnings section, which means that the balance on the retained earnings section will definitely be reduced. So these are all the transactions. Now we can figure out the closing balance. So that would be retained earnings at 31st December 2019. So let's have a look above. We are given the balances at 31st December 2019, and we can see that the retained earnings are the value of 112,000. So let's record this as our closing balance. So that's 112,000. Alright, then we figured out our profit for the year right here, and it was 72,000. Let's record it as well. We are adding the profit. Then we also figured out our dividends paid, which is 36,000, and we need to subtract this dividend. So that's 36,000 in a bracket. Then we are given information regarding the transfer. An amount of 10,000 had been transferred from the retained earnings to the general reserve during the year ended 31st December 2019. So we will be subtracting this transfer value as well. Okay, now we do not know the value for our opening retained earnings balance, so this will act as our balancing figure. And we know that whenever we're trying to figure out the balancing figure, we just need to subtract these values from the total. So in this case, that's going to be 112,000 minus 72,000 plus 36,000 plus 10,000. So these two are added because these are already a negative, right? And we again subtract it. So two negatives become a positive. So in this way, our retained earnings at 1st January 2019 will be 112,000 minus 72,000 plus 36,000 plus 10,000, which results in our opening balance to be 86,000. Okay, so this concludes the second part of this question. Now we can move towards the third one. Alright, we were given the working section right here, so instead of scribbling all over the question paper like I did, you guys should be mentioning all of your workings in this particular box. Then we are given additional information. Okay, let's have a look at our third question. First, we need to define the term impairment of assets. And we know that the impairment of assets is given in our International Accounting Standards 36, right? And it defines that an asset is impaired when the carrying amount of the asset is greater than its recoverable amount, right? So let's write it down. According to IAS 36, an asset is impaired when the carrying amount of the asset exceeds its recoverable amount. Okay, and we know that the recoverable amount is the higher of an asset's fair value and its value in use. Let's write it down as well. So this concludes the third part of this question. Now we can move towards the fourth one. We need to explain how the directors should adjust the draft financial statements to account for issue 1 as well as issue 2. So let's have a look at our first issue. Okay. During the year ended 31st December 2019, MPLC bought a specialized machine, and the machine had been designed by MPLC and made by an overseas manufacturer. The following costs had been incurred. So the costs were design, manufacture, installation, repair, and maintenance. Okay, we can see that these three costs are capital costs, right? And these are the capital costs because these do not recur in the future, right? So these are non-recurring costs. And we also have repair and maintenance, which is revenue expenditure. And this is a revenue expenditure because this can definitely recur in the future. We might have to repair and maintain our specialized machine in the future as well, right? So this is a recurring cost. Okay, and then we are told that MPLC had capitalized the manufacturer cost 26,000 and all other costs were charged to the income statement. So like I said before, instead of just charging the manufacturer as a capital cost, we had to charge our design and installation as well, right? But in case of MPLC, they actually capitalized the manufacturer cost and charged the design and installation towards the income statement as a revenue expense. So that's an error, right? The company depreciates the machinery at 25% per annum using straight line method. A full year's depreciation is charged in the year of purchase. Alright, so for issue 1, the error here was that we charged our design and installation as a revenue expenses rather than charging it to our capital expenditure, right? Let's write it down. So the accounting treatment would be that the design, let's have a look at the value of design and installation. Design was of 7,000, whereas installation was of 3,000. So design 7,000 and installation 3,000 are capital expenditure which are non-recurring expenses. Okay, so now we can move towards our second issue. we can see that MPLC owns a warehouse and it was purchased on 1st January 2015 at a cost of 150,000. Okay, this is the date at which the warehouse was purchased, and the current date we're talking about is 31st December 2019. It has a useful life of 25 years with no expected residual value. Its carrying value had been included in the total value of non-current assets. So here the carrying value is just going to be its net book value at 31st December 2019. So, okay, I'm just going to prepare a timeline. So we have the year 2015, 16, 17, 18, and 19. And we purchased the warehouse at this point, beginning of 2015, and we are talking about the net book value at the end of 2019, which means that we need to charge depreciation for these 5 years. So let's figure out our depreciation charge per year. And we know that we are given the cost, and we are given the expected residual value to be 0, and we're also given the useful life of 25 years. So the formula for depreciation per year would be cost, that's 150,000, minus the expected residual value, which is 0, and divided by the number of useful years, which is 25. So this gives our depreciation per year to be 150,000 divided by 25, which results in the value of 6,000. And this is the depreciation per year, but we require the depreciation charge for 5 years to act as our accumulated depreciation, right? So accumulated depreciation is just going to be the depreciation per year, which is 6,000, times the number of years, so that's 5 years. And this gives the total accumulated depreciation to be 30,000. And we're just multiplying it with the number of years because we know that this depreciation charge is on the basis of straight line method, meaning that depreciation charge for each year will remain constant at the value of 6,000. Okay, so this is the accumulated depreciation. Now we can figure out our carrying amount. Carrying amount is just the net book value, which means that we need to subtract our accumulated depreciation from the cost. We have the cost of 150,000 and our accumulated depreciation 30,000, which gives the carrying amount to have the value of 120,000. Okay, and its carrying value had been included in the total value of non-current assets without taking into account its fair value of 100,000 and value in use of 112,000. So let's have a look here. We defined impairment of assets right here, and we said that an asset is impaired when the carrying amount of the asset exceeds its recoverable amount. And we also told that the recoverable amount is higher of the asset's fair value and its value in use. So let's figure out our recoverable amount. So recoverable amount is going to be the higher of the fair value and its value in use. And we can see that fair value is 100,000, whereas the value in use is 112,000. Clearly, the higher one is the value in use, so recoverable amount is going to be 112,000. And the impairment loss occurs only when our carrying amount is higher than this value of our recoverable amount, right? Let's have a look above. We figured out our carrying amount to be 120,000, right? Which is definitely higher than our recoverable amount of 112,000. So there is definitely an impairment loss. Let's figure out our value for impairment loss. This is just going to be the difference between carrying amount and the recoverable amount. We figured out our carrying amount to have the value of 120,000, and we figured out our recoverable amount to have the value of 112,000, which gives our impairment loss to be 120,000 minus 112,000, which results in the value of 8,000. So the problem with second issue is that recoverable amount is higher of fair value and the value in use, right? And the carrying value is obviously more than the recoverable amount, therefore leading to an impairment loss. Let's write it down. Okay, so the first thing is that recoverable amount is the higher value of its fair value, which was given to be 100,000, and its value in use, which was given to be 112,000. Okay, then the next thing is that we figured out our carrying value. Carrying value or carrying amount, we figured it out to be 120,000, which is more than the recoverable amount and recoverable amount is higher of the fair value and value in use, and obviously the value in use is higher, so which means that the recoverable amount will be of 112,000, right? So this leads to an impairment loss. So impairment loss is just the difference between carrying amount and recoverable amount. So that's 120,000 minus 112,000, which results in the value of 8,000. Okay, this concludes the fourth part of this question. Now we can move towards the fifth one. We need to calculate the adjusted profit for the year after considering issue 1 and issue 2. For this, we will start with our profit for the year. And we figured out the profit for the year above. Right here, we can see that the profit for the year was 72,000. So we will be starting with this amount. That's 72,000. And now we need to adjust these two issues, right? So for the first issue, we had charged the design and installation expense as a revenue expense to our income statement, which should not be the case, right? So we need to reverse it. So previously, we subtracted the design and installation as expenses. So in order to reverse it now, we just need to add the design and installation cost back to the profit. So that would be plus 7,000 for design and plus 3,000 for installation. Let's do that. So that's add design with the value 7,000, and we also need to add the installation 3,000. And since we are now capitalizing this cost, we also need to charge the depreciation on our additional capital, right? So we can see that our additional capital will be that of design and installation, right? So additional capital is 7,000 plus 3,000, which results in the value of 10,000. Then we know that the company depreciates the machinery at 25% per annum using the straight line method. So in order to figure out our additional depreciation, we can just charge 25% to this value of additional capital, right? So that would be additional depreciation, will be additional capital of 10,000 times the depreciation rate of 25%. So this gives our additional depreciation to be charged or adjusted to our profit for the year to be 2,500. Let's adjust this. So depreciation should always be deducted. So that's less additional depreciation. And this is of 2,500. Okay, then finally for issue 2, we figured out an impairment loss, which should definitely be treated as an expense and deducted from the profit. So we will subtract the impairment loss as well. Which amounted to 8,000. So that's 8,000. We need to deduct it. So now we can figure out the adjusted profit. And that is just going to be the sum of these 5 amounts. So that's 72,000 plus 7,000 plus 3,000 minus 2,500 minus 8,000, which results in the value of 71,500. So this concludes the 5th part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel so that you do not miss any of these videos in the future. Thank you.